What are the pros and cons of adjustable rate mortgages for newer commercial investors?
So the interest rate that is variable, the problem is we're taking a little risk here because we don't know if you take one that adjusts monthly, which there are construction loans that adjust monthly. The construction loans, like you're taking a property, you're going to build an area in the back, you're going to add a second floor or whatever. The interest rate right now, they can give you probably fixed rate on the property and a construction loan that's variable. And if your construction is going to take more than a year right now, like maybe 18 months, you're taking a big risk. Be very careful, because if it adjusts monthly, they can say that the minimum will be 7.5, but it can adjust up to 5 points or up to whatever the market will bear. And these lenders have been waiting and praying for the change in the market for them to make the big money. They are going to be ruthless with a smile. So sorry, Todd, we love you, but your payment went up from 15,000 to 18,005. We understand, but we were hoping maybe you can refinance with somebody else. You can't. You're halfway through the construction. You're going to have to cough up the money. So be very careful. Construction loans, you won't be able to. I'm telling you, it's not in the market. I'm doing rehab in San Francisco, and I've dealt with the same bankers for years. I was dealing with Goldman Sachs, and Goldman Sachs sold the division called Genesis Capital that does the construction loans, so they can play the game of, sorry, we got to increase your interest. The good advantage I have is that we have a lot of equity in these properties. We're almost done with rehab. We got a property on the market now, 86th Avenue. You could see it at 7 million, residential home. 3 more properties coming up on the market. Those who are in the real estate fund, you've seen my letter. It came in the mail already. We have 17 properties in Old San Juan, steady loans. We refinance at 6% fixed for 25 years. Just beautiful refi, perfect timing, cashed out millions of dollars, put them in the fund, looking for deals and all this. But I'm finding that, hey, the good deals are not here yet. So we're making low offers and we're managing the money as carefully as possible. So be careful of the variable. If you can get fixed and live with it, make sure that you can refi at very little cost. So if you get the fixed and you're paying a little bit more than you will, you at least know that that's what you're going to pay. And then when the market goes down, because eventually it's going to go down, the government, and I can show you statistics. I don't know if I can pull one right here. Let me see if I can pull one statistic that I think will be very interesting to see.
If you guys could only see his screen and how many things he consistently has opened, it would make you crazy.
Okay, so here we go. So here is a screenshot of federal funds. Okay, this is a pretty interesting one. Okay, so when you see here, historically, how the money worked. Okay, so you had these... Okay, so you remember in the 80s, interest rate went up to 18, 19%. You see this? These gray areas are the recession times, okay? These are recession times. See recessions, and they're pointing at the gray areas. So 81, market just collapsed when the recession happened. Okay, they actually dropped interest rate. It didn't work, boom. Went up again with the interest rate. I'm sorry, I said market, but it's the interest rate went up to 18. They dropped a little bit, then went back up. It was a disaster, okay? It was very hard. Then the market started going down from like 83 or so. Interest kept going down, went up a little, down through the years. Here is September 11, 2001, when the terrorist attack happened. What did they do? They were starting to come up with the interest rate. Boom. They dropped interest rate. Federal fund target rate was at like 2% because they know we drop the interest rate, the banks, and they print money, then the banks can loan it and everybody can afford things. And cap rates kept declining for the last like 19 years, okay? Then in 2008, 9, remember, interest rate had gone up a little bit, and then they had to, here 2008, the interest rate was at 5%. They decreased interest rates down to 0 so they can get the economy going. So it was a crazy market, but you notice that every time they increase the interest rate, what they have to do, they have to drop it again. Increase interest, they have to drop it again. they increase, they drop it again. Okay. So what happens now is interest rate going up. So sooner or later, they're going to have to drop it. So if you get good assets right now and you hold on to the good assets, that cash flow or stuff that you're rehabbing and stuff, by 2025, you're going to have a very good position to be able to make good money. In 2009, I was buying from the bank in bulk because I had a lot of cash and I was selling. We did so well for 3 years. People got wiped out 2008 and 9. Now, right now, I'm being very cautious. Actually, we're selling 3 properties by the end of the year. I'm going to take several millions and we're going to pay down the debt on the other properties, which I've never done, but it's going to give me a very powerful position that by 2025, when we cash out of 2 properties on Billionaires Row, we're going to cash out tens of millions of dollars in cash and go into bigger properties that are going to cash flow very well.